with us, we have John Neihart and also the legendary JC Faulkner. I'm really excited to have you guys on this. I just want to do a sound check. Are you with us, JC?
I am.
Fantastic. Great. John, we got you there too, right?
Yes, sir.
Wonderful, wonderful. Listen, before we get started, and I'm going to turn the controls over to John. John's going to kind of control this for us. But I'm going to kind of sit silent here, and John, take it away.
Hey, thank you, Andrew. Appreciate that. So I'm going to open things up and get it started, and then I'll get JC involved. So we all know this business is cyclical. It's month to month, year to year comparisons, and most of us on the phone most likely had record years last year, and we're starting off 2020 with some big expectations. But really, what is your long play? Or what are you doing to think past 2020? And there's really two ways most of us look at this business. There's the strategic viewpoint, the high level view, like a CEO or senior level executive, or those people building and leading companies. And then the other perspective, there are those of us executing on that strategy. This is more of a tactical view, more typical of our middle and frontline team members. And in our business, it's the people with a month-to-month focus, the here, the now, the doers. And as kind of a true outlier to that normal way that most of us look at the business, you have some of the leaders whose companies not only help shape the segments of the industry, but they're really looking at the long play, the overall market cycle, and along the way, they have their focus on the upside. And today, we are really fortunate to have someone, in my opinion, that always seems to be 5 steps ahead of the industry. And JC's been successful throughout his career as a founder and lead investor, starting companies at the beginning of cycles and market shifts of the mortgage industry. And really, I first heard of JC in the 90s when he founded and built Decision One, which was predominantly a wholesale company supporting the broker community and mortgage companies across the country. And just on a quick side note, JC, you probably don't even know this, but I was a retail LO back in the 90s, and I made the move to starting my own broker shop, and we brokered our first loans through Decision One, your company, and we worked, the majority of our pipeline for the first 5 years was sent through D1. And then kind of fast forward to 2009, JC was one of the lead investors in setting up Quicken Loans Mortgage Services. He helped put the deal together that actually put them in the wholesale business. And I still remember that recruiting dinner, I think it was the Palms, before the division was even open, and how I took the opportunity really in part because of JC's vision. And I remember distinctly how he discussed the cycles of the market in relation to starting up the channel. And now here I am, kind of fortunate enough and thankful to look back at those opportunities and see how they matured. And I know you're traveling today, JC. You're actually calling from a hotel in New York City, and we appreciate you taking the time. I'll quit talking about how great you are, let you say hello, and then I'll jump into the first topic.
So one thing I would say, John, is I do remember you sending business to us. And I could be wrong, but I think you might have been our favorite LO in the whole country. Secondly, at the Palm, I do remember that I picked up the check when we were discussing that 10 years ago.
Thank you very much. Appreciate that.
So the other piece is I guess we've been doing business a long time. So this is 3 companies later, we're still doing business together. So as always, glad to be a part of your team.
Oh, it's the other way around, sir. And I know that, our business is really affected by so many things. It's often easy for us to overcomplicate what's really important. And one of the things I think we can all agree in is that the cycles of various markets seem to affect our business as much as anything else. And, election cycles, economic cycles, and of course, housing cycles. And like I just mentioned, I was a broker in the 90s and 2000s, and I saw that, being a mortgage broker kind of came out of favor in 2008. And we should all know that segment right now is growing and thriving. And, whether you're looking to grow your current business and build on what you have, whether you're considering the move from retail to broker or move from one lender to another, kind of understanding the market and its timing is crucial. And we all know that when pipelines are full it's sure difficult for anybody in the sales to make a move. And when the buying season is in full force, getting realtors to attend or getting their attention, is hard. And today, when you're flush with business, it's really hard to look too far forward. And, understand that. But I think the election cycle definitely affects us all. And not just because of our Facebook feeds and those uncomfortable family gatherings, right? You kind of, it affects the economy. And, but really it seems to affect our business more than most out there. And really this fintech disruption that's changing the way we all think about our business is on us. And we all know that we're somewhere in the beginning stages of this fintech disruption. And in a recent study by Fiserv, it was pointed out that borrowers last year were 35% more comfortable taking out a loan through a tech company than in 2017. And as you kind of look at additional cycles, the cyclical nature of home sales over the years have been something that we're all aware of. But in general, most of us don't focus on that big macro viewpoint of our business, right? So even though the cycles of our business affect us all, I think a lot of us can remember just as far as last year when the margin compression and how that affected us all. And, if you've been around long enough as I have, I remember the cycle of 98, the downturn in 2008, and now here we are, looking at I'm actually showing, and I don't know if you can see this, JC, but I'm showing a chart of interest rates from 1990 to today. And within that chart, I have the timing as to when you started these various companies. And you've invested and co-founded 5 companies since 1996. And so far, you've been able to sell 3 of those, and 2 of the others are essentially at the beginning of their cycle. And, another side note, Spring just turned 4 years this week. So congrats on that. And many of us with the entrepreneurial mindsets think about selling or having some type of exit strategy during our careers, but you've been able to do that successfully multiple times. And we all know that success leaves clues. So if you could please help us understand, what criteria did you use when entering these markets over the years? And can you share some insights with us regarding the timing of the cycles?
Okay, well, I'm going to assume that most on this call are in the financial services business. So,
yep.
Which is, cycles are determined by interest rates. But I also believe, there's never a bad time to start a good company. And whether you're in the business of starting companies, which I guess I've defaulted to, or you're running your own company, you gotta have a good feel for the short term so you can make money and survive day to day. But it's important to be able to have some idea how that fits into the long term, especially if you're building a company that you hope that someone will buy. And I think everybody aspires to that. So, and I think that's a good thing to aspire to. But when it comes to starting a company, I've got 4 criteria that I've distilled it down to that works for me. And everybody's different, and I'll just put a disclaimer out there. My criteria may not work for everybody, but it works for me. And in no particular order, and I give all the same weight. The first thing is there a change in the market that's inviting a new entrant? And an obvious one is when rates change. If as you enter into after a increased interest rate environment, that's always the easiest time to start an origination company, because when rates go up, 40 to 50% of the origination companies will exit the business until rates come back down again. So clearly it's less crowded. But when it comes to starting a company, oftentimes a more compelling reason can be, is there a shift in the market that existing companies haven't accommodated for? Or is there a shift in the market that gives everybody an equal footing at the beginning of that shift? So you've mentioned 5 companies I'm involved in, 3 that are that I'm no longer involved in, and 2 that are currently active. As we go down this criteria, I'll give you examples of the 2 companies I'm active in because it's more real time. So what shifted in the market that made me want to get involved with Spring EQ, and we're going to talk about a servicing company as well, ServiceMac. With Spring EQ, what the shift is that there's been a historically long and historically low interest rate environment, 2 distinctly different things in the same last 10 years. And what that's created is a historical amount of equity that's trapped in residential homes. So since the meltdown of '07, you had a remarkably smooth recovery over the last 10 years. And 2 things have happened. A tremendous amount of equity. 3 things, actually. Tremendous amount of equity that's in these homes. A large percentage of people who have taken advantage, actually most more than once, of the low interest rate environment we've had the last 10 years. So people right now are unusually high amount of folks have probably the best mortgage they're going to have, and they have it right now. And then so with those 2 things, you've got an opportunity for the home equity business to make a resurgence. And with the advent of technology, it's gotten easier to do these home equity lines. So if you look at that, there is right now, like our business at Spring EQ, we've doubled it over the last 2 years. There's other people now getting interested. So because it's been the type of historical 10-run period that we've had, the home equity business has been dormant. There's probably some folks on this phone, if you've only been in lending 10 years, you wouldn't have known that the home equity business was a very large business prior to the last 10 years. And the reason for that is a typical rate cycle was anywhere from 4 to 6 years. And it was that way prior to 2001. It was that way for the previous 30, 40 years. And the reason it's changed is when 9/11 happened, a lot of people don't remember this, but rates had gone up 3 or 4 times in 2001 to end a 6-year low rate cycle. And after 2001, after the rates went up 4 times, rates were lowered 7 times that year in response to 9/11. That triggered, that stopped the cycle from going up and extended that low rate cycle. So that turned what was a 5-year cycle into a 12-year cycle. And now we have a subsequent 10, 11-year cycle behind that. So because of that, it's been dormant. But as we get into the 10th year of this particular cycle, and with an election coming up, I think everybody would agree that rates have nowhere to go but up. The question is when. They tried to do it a little bit last year, and then it stopped. And then with the election coming up, some are thinking that there's a good chance that that would be the time. So having said all that, the home equity, the market right now is right for the home equity sector to reopen. So again, when we talk about 4 criteria, I'm talking about there's got to be something in the market that makes it compelling, and that makes it compelling for us. Number 2, you have to start a company. You have to feel like you got to be convinced you've got a world-class operator who's got a track record that can start a company from scratch and develop it, knowing the market conditions. And so with Spring EQ, you got Jerry Schiano, who is the CEO, and this is Jerry's 3rd company. So Jerry was successful back when I had Decision One. He had WSFS, and he successfully built that, and it was sold to AIG. He became one of the top 10 lenders at the time, and a competitor of mine, a respected competitor of mine. And then he also he was the founder. I was the lead investor of ShellPoint, and we started that one when in 2007 and 8, when after the market meltdown, and again, good time to start a company. But he is at the helm, and you got to believe that you've got a world-class leader that can start a company. Third criteria is you got to have patient capital and the right amount of it. So the only thing I would say about that is patient is important so that it's designed to go longer than you think you need it. But more importantly, a rule of thumb I have is when you sit in a conference room and do your pro forma, and you give a conservative estimate of when you think you're going to break even and how much money that takes, what my belief is, whatever that number is, you need to raise or have access to twice that amount. And the reason for that is when you, in a conference room, you can't see everything out there. There could be a potential speed bump that will cost more money, or can you see some potential opportunities once you get out there and start where you need capital to maybe recruit an executive you didn't know you could get, or pick up a company at a discount that you didn't know you could get that could be an integral part of what you're doing. I'll give you the best example I know of this is with the servicing company, ServiceMac, that we started 2 years ago. What I didn't put on my list of risks was that the government would shut down for 2 months while I was trying to get licensed. So at the time that the government shut down, I had 70 employees, and it extended the licensing cycle by 2 years. I could have never, it was historical, could not have projected that, but it cost a material amount of capital to do that. So patient capital and enough of it. And if you make a mistake on raising capital, it's better to raise too much than too little. It's much easier to give back capital than it is to raise it when you are falling short. Fourth criteria is, and this is a real important one for me, I wouldn't start a company without it, and that is you feel like you have to have an anchor tenant as a customer. One customer who is there to buy your product, is there to be your customer out of the gate so that it helps you skip over the burning capital period or manage that period effectively. So 2 reasons. It helps you validate the capital you raise, and 2, it gives you a superstar client to point to when you do your sales presentations, all your other clients that you're trying to set up. So those 4 things just are the criteria that I look for when I start down this pathway. And then, John, you asked me to just make a comment about when's the right time to sell a company.
Yes, sir.
Yeah, this one is, there's a universal truth about selling a company, and it is the time to sell a company is when you are no longer 80% convinced that you can continue to make it more valuable. And that could be for a litany of reasons, but it could be market driven. It could be that you're at the end of your career. It could be that you're at the top of your capabilities. It could be that you're tired of doing something. So it's really important to know when you get to that point, there's no free ride when you're running your own company, and you can never coast. So if you're not growing it, you're shrinking it. And so when you get to that point, that's when it's time to really look at either selling all of it or potentially selling a piece, part, or majority of it to a company that is larger with a bigger balance sheet that then will give you additional resources to continue to grow it. So but the one thing I would say there is when you're no longer convinced that you can add value to your company is when you really, really need to plan to sell it. So if you look at the things I've been involved in, because it's interest rate sensitive, if you can time it, you want to sell towards the end of a low interest rate environment if that opportunity presents itself in this sandbox.
Gotcha. Well, I appreciate
so, John,
that.
That's the best insight I can give you that I've learned over the last 25 years of doing this.
No, that's great insight, and also the last point there about time to sell the company. I appreciate that. Thank you very much. And so let's transition over to, you mentioned ServiceMac, and let's transition to your take on servicing. So we know that in 2019, that was a great year for originators, right? But it was a challenging year for service companies, specifically their retention of customers, right? Prepayments have been up since the beginning of 2019 because of this low rate environment. And according to this recent mortgage monitor from Black Knight, 3 out of 4 refi borrowers were lost by servicers. And this is like these in the money borrowers that have historically been easier to retain. And that's caused servicers to truly dive deep into borrower data. And now we're seeing this shift in the wholesale market, this trend towards referring borrowers back to broker originators due to some type of trigger event, whether that's mortgage inquiry or house just listed for sale or refinance or payoff request. And most of the top wholesalers out there have some version of a reconnect program. And the servicing side of our business is a pretty interesting one right now. And I think it'd be a good to get your viewpoint, not on those specifics about referring customers back, but just on that side of the business in general. So would you give us kind of a high level view of the servicing and sub-servicing, and what information do you think would be helpful to share with the group?
Okay, yeah, the servicing, sub-servicing sandbox is a kind of a quiet sandbox, and it's been pushed to the forefront over the last couple of years. To a couple of things, just a table set. Going back to the previous criteria, the reason that I got involved in the sub-servicing space is, let me back up for a second. There's servicers and there's sub-servicers. So just a brief distinction between the two. A sub-servicer, which is what ServiceMac is that I'm involved in, is a company that will service someone else's MSR for a fee. So as a sub-servicer, you don't have ownership in the MSR and the risk associated with that, or the reward associated with owning it. You simply are fee for service. And a servicer, in simple terms, is an entity that owns the MSR that also services the MSR, or is in charge of servicing that. So an example of a servicer is Wells Fargo, as probably the largest servicer in the country at 9 to 10 million strong. And then you have non-bank servicers, which is non-banks, originators who actually own their own servicing units. Quicken Loans is a shining example of that, as well as Mr. Cooper. So I just wanted to level set with that. So if you look at the reason is the shift that's going on with the servicing business, I think it's important to know this, it's been a sleepy category for a while, but now it's growing. And there's two reasons that it's growing, two primary reasons. One is banks originating mortgages. Their desire to originate mortgages has decreased over the last 5 years. It's less attractive for banks to originate mortgages. They don't compete as well on their balance sheets. And so most banks have settled into mortgages as an accommodation for their clients. And so within their footprint, this has shifted the origination away to non-banks. And this has created an opportunity. This has helped fuel the growth of non-banks. And you can look at your top 5 retail lenders, particularly look at your top 5 wholesale lenders. And at the heart of this, you've got banks that are not going after this business as much as they normally would. Well, how does that impact the subservicing business? Well, banks, when they make their own mortgages, they typically service them. And and those that aren't made there by non-banks, they typically sell them off to MSR aggregators. So that business, with the banks decreasing and the non-banks increasing, that's had an impact on the need for subservicing. The other reason for my interest in getting into the subservicing business is that the aggregators that are now buying MSRs, they're becoming more sophisticated. There's fewer of them, but they're becoming more sophisticated and they're becoming bigger. So their need to have more sophistication with subservicing and their need to have more retention capabilities, their need to control that valuable product and their sophistication has gone up. We were told by the agency that there hadn't been a startup subservicing company in 10 years. So what that also implies is the technology that the new aggregators or the aggregators, the bigger ones, are requiring more sophistication and have a need for the newest and greatest technology to manage that. A need to manage the cash flows and a need to have more insight to their investment. So number one, it's just good to know what's driving the shift in that sandbox. So now the question is, how does this impact originators? Well, if you look at what a subservicing company does, we all share the same customer at different points of the life cycle. But a subservicing or a servicing company, they both have the same job, and the same job is to maintain the value of the MSR. And there's two ways to maintain the value of an MSR. It's extend the life of the MSR, and it is to provide quality customer service to do everything you can to make sure that the MSR performs. Now, the reason for that, the longer the MSR stays on the books, the more valuable it is to the MSR holder. I think probably most people understand that, which is also why if portfolio is being churned or one is refinanced, it's, the minute that it's refinanced, clearly something that an MSR holder bought is no longer valued, it goes away. As it relates to the performance of the loan, a servicer or subservicer is challenged with educating the customer, staying in touch with the customer to make sure that they perform as well as possible, because if the customer is not paying their mortgage, then the MSR holder does not get paid. So the ability to make it perform at the highest level is important. So maintaining the value through those two things is a critical point. Now, having said all that, there's no secret here, but as the sub-servicers and servicers get more sophisticated, they're being challenged to become better at retention. And in the last couple of years with the payoff speeds, typical sub-servicer or servicer wasn't typically staffed for the avalanche of payoffs. So, and that's all, then all that gets reflected in the price of the MSR. So, it's a zero-sum game with the MSRs. So it's important to know that originators and MSR holders, they share that boundary. It's a tug of war, but it's a zero-sum game. So the sub-servicers are now being challenged to meet that demand and be more sophisticated in accommodating what the MSR owner wants us to do, or wants the sub-servicer to do. Here's three examples. And these are three different clients' needs that we have at ServiceMac. A top 10 lender is a client, and they want our company to allow them to answer the phones so they can stay in touch with the owners, so they can stay in touch with the customers of the MSR that they own. So we have to, through component technology, we're able to allow them to answer the phones in a private label arrangement so that they give that customer one more reason. All the customer service questions they answer gives them one more reason and opportunity to retain that loan or refinance that loan when that customer needs it. We have a second customer is a large aggregator with no retention capabilities. So they rely upon us 100% to stay on top of the book. And their expectations are, in this particular market, a minimum retention rate would be 30%. John, you asked earlier, what's a respectable retention rate? And it varies market to market. In this particular market, because a lot of the retention is refinances, a decent Mendoza line is 30%. Now you have some companies out there that that's just a good Mendoza line. There are companies out there, that are pushing 40 that are better, and there's companies out there that are below 20, and they're not as good as they should be. So I would say 30% is a good level in this particular market. When the market shifts, and a lot of that's because it's refinances. When the market shifts and there's less rates go up, and the shift goes between refinances, flip-flops between refinances and purchase, the retention rates will probably go down, because it's harder to retain a purchase because you don't have the same lead time, you don't have the same opportunities. You got to be somewhat preemptive to retain a purchased loan opportunity, and there's more people involved to pull that loan away from you. So that's the second example. Third example is we have an aggregator who buys MSRs that has their own refinance retention unit. And so the way we work with them is that we obviously have some of our obvious triggers when people pull rates, when tax amounts, when escrow tax amounts change, when a rate changes, anything that impacts the payment of that MSR is a natural trigger. But anytime we know that someone is thinking about it, or we preemptively have information that makes us think that, then we will feed that information. We'll work with the aggregator within their unit to allow them to do that. So three different examples there of how a sub-servicer works with MSR owners to make that happen. So the bottom line of all that people on this phone just need to be aware of is that sub-servicers and servicers are, competition. They're originators at a certain level. And so it's really, really, really important to do things as an originator. It's really important to make a lasting imprint on your originating customer before you sell that MSR, so that when it's time for them to refinance or to do something, that they're still thinking about you. And just know that servicing companies and sub-servicing companies are doing everything they can to make them think about the sub-servicing company and the servicing company. So just some awareness that it's flat out competition.
Absolutely.
So that's probably a good segue into what you can do for that customer that makes them think about you more. And it's probably a pretty good segue into the second mortgage product.
Yeah, you bet. So I'll pick this up right now. Great insight on the servicing side. And I think the home equity business, and we know that business is poised for growth. And in a report on home equity business, TransUnion noted they anticipated this segment to continue to gain momentum, basically doubling from a previous 5-year period to the current 5-year period we're in now. And, I think I told you before, I believe so much in the second mortgage side that I left the first mortgage side, and, very excited to be part of this. So, it's really been established that your timing seems to be right more than it's wrong, and I haven't, it's pretty well proven here. And you started your career at First Union Home Equity, and now you're an investor and a board member of this home equity company. And we can see based on your timing, and I'm just sharing a screen here with the idea of over the last 20 years, how equity has really grown here recently, JC, just so you see it, and the timing of starting Spring EQ. So I'm assuming that you had plenty of options to use your investment and business knowledge, but you chose home equity again, and maybe you could give us your thoughts on the second mortgage home equity and it's kind of re-emerging into the business.
Okay, well, I would give credit to Jerry Sciano. He's the one that came to me with the idea. So if this turns out that we're right, I'll take the credit. If it turns out we're wrong, I will blame Jerry.
Yeah, he said the same thing, I think. So
did he? That's not surprising. I spent the first 12 years of my career from 84 to 96 working for First Union Home Equity Bank. So I'm probably more fond of the business than most because I spent a lot of time with it. And it's important to note that the first mortgage business that we're in today, especially the refinance business, is the refinance side. That's a rate-driven business. Now the purchase side is a need-driven business because people want a house, need a house, they get a purchase money. But the majority of the business today, which refinances, is a rate-driven business. It's important to know that the home equity business is a need-driven business. So what I used to find amazing back when I was doing this full time was you could refinance a mortgage for $200,000, and people were somewhat appreciative. You could make them a $30,000 second mortgage so they could build a pool, and they were ecstatic. They were ecstatic with you, even though one loan was significantly smaller than the other. So just important to throw that out there. And now, as people get locked into their first mortgages now, that this equity is in there, and people are going to access it. You look at the credit that's being accessed through personal loans, through credit cards, et cetera. That's all that business will trickle down through this channel, through the home equity space. And then there's a math play right now on a lot of loans. You use the term in the money with first, but there's also in the money with seconds, and seconds that make more sense to do as seconds when you combine the two mathematically than to do a refinance. Now, as an originator, if you can do a refinance, you can do it all day. Do it because it's a bigger loan. It's one loan, but you want to be able to have a product there for when people mathematically it doesn't make sense or they want money faster. So as I look at this, I want to go back to, if you look at the market, it's been, again, I've said this earlier, it's been dormant for 10 years because of the historically low rates and the historically length of time that we've had low rates. So if I look at second mortgages, and I'm just going to keep this really simple. There was a time 3 years ago, I'll make an analogy, when 90% of the business was refinance and 10% was purchase. And companies got ahead of things, said, okay, this refinance thing can't last forever. We really need to focus on the purchase. And so the smarter originators are out there driving their purchase money business up as a hedge to when interest rates ultimately do change. Well, and some do it better than others. Well, I would make the same analogy for the home equity business. That there's three reasons to really look at this. One is it's a natural hedge to when the rate cycle does edge up. And nobody knows when it's going to happen. We all just know at some point it will, and it probably will during the careers of most people on this phone. So number one, it's smart to start now building those muscles so that you can transition successfully. The average size loan, and I'm not going to get into great specifics because I know Jerry Sciano and Todd Highfield are scheduled for a more tactical discussion later, but the average loan at Spring EQ is 55 to 60,000. So clearly it takes 3.5 of those to do a typical first. But the fees generated from it are equally good. And so it truly is it's a real revenue creating product. But the time to do it the time to figure out the muscles is now. That's number one. Number two, it's a real opportunity right now because that sector is growing and it's the revenue opportunities are there. I won't mention by name, but it's interesting. We've had we've had one particular entity whose name I won't mention, one particular company that in one of their branches actually did 20 home equity loans. So they just started making it a part of what they do and found that when they tapped into the needs of somebody that either just closed on a house that they talked to before, that if you talk to somebody about a home equity loan, typically they've got excess credit out there with their credit cards, personal loans. They've got everybody's got seems like most people have a particular need if you just sat them down to talk to them. And so there is a burgeoning opportunity right now that's really being missed, particularly if you already have the person on the phone. So one, get ready to do it before revenues go down when rates go up. Two, it's a real opportunity right now. And then thirdly, it's a way to deliver one more product to a consumer that is going to be, you just had a first mortgage transaction with them. It's another way to do something for them to leave a lasting impression. Absolutely. And so with the non-solicitation elements in the market today, you want to give that customer one more reason to call you back. And so that is that's a great way to do that. So it's ancillary. Any way you look at it, it's ancillary, but it doesn't mean that it has to be immaterial. So we're all fighting, just like now originators have to compete with sub-services that are getting smarter. And so anything you can do to give one more product to your consumer, and I wouldn't just stop at home equity loans, anything you can do for them that gives them one more reason to remember you and thus call you back is always a smart thing to do. And I'll kind of tie this into the beginning of the discussion for folks who are owners of businesses on the phone, and for people on the phone who think they may want to start a business. When it comes time to sell a company, companies that have multiple lines of businesses prove that they can adapt to changing environments, prove that they can manage multiple product bases. Those are the companies that larger companies who are trying to bolt something onto their entity will look at. So I didn't say this earlier, but anytime you're building your company, there's two lenses you have to look through. One lens is what do I have to do to compete head to head in this market? Number two, what do I need to do in the design of my company that makes it easy for a larger company to bolt to want to acquire my company, and then thus what I've built becomes scalable within that entity. So if you look at example of that is, if you look at Decision One, when we sold to households, we were doing $100 million a month. Believe it or not, we were the largest non-bank supported entity at that time, which is why I sold it. And then after that, 5 years later, we were doing $2 billion a month. And it was because we built something that was scalable, but we had an idea what scalable was. If you look at when Jerry sold his company to AIG, same thing. His production went up fivefold in a matter of 3 years because he built a scalable company that could manage, more than one product. So just important to be able to keep that in mind.
Outstanding. Anything else you want to add to that? Because we can open it up. Andrew, when you're ready, we can open it up to some questions.
Fantastic.
Well,
go ahead,
I just know there's a lot of seasoned lenders on the phone that understand all this, and I think it's just a matter of making the decision: are you going to do it now or do it later? Because doing it now gives you the opportunity to make money now and be positioned, or you'll do it later when revenues go down, and you need to not only have one more product for your consumer, but also you need to have another product for your LO to sell, because it's you got to keep feeding the beast there too.
Right.
That's it. So I know you got a handful of questions. I see we're coming up on the hour. So we'll run over these last few questions quickly and let folks get back to the end of their month.
Yep, fantastic. So And and I just want to say we have so we do have a handful of questions here. If we do not get to your questions, I apologize. Someone actually from the team, from the Spring EQ team, will definitely get back to you. But we're going to go through these questions. But just keep in mind, this is the first of a 3-part series. So hopefully you should have received an invitation to the other sessions. Just stay tuned to your email, your inbox. If you haven't we have more coming up, but let's go right to the questions here. All right, here are some, we're going to kick this off. Do you see any other parts of the mortgage market that are poised for disruption?
I'll hit on 3 real quickly. Keep an eye on the banks, because the banks, their appetite going down with mortgages has invited non-banks to pick up that opportunity. Now, what's happening is that the regulators, I believe, are getting unintended consequences of their heightened regulation. They don't want the banks' appetite to go down. They like having the banks more involved. So there are a lot of discussions going on right now to get the banks re-energized about this space. So you just want to keep an eye on that. Now, to the benefit of the folks on this phone, that moves, those discussions move slowly, but they nonetheless move. So right now, in those discussions taking place in Washington, the regulators can use carrot and sticks. Right now, they're using carrots, and at some point they may use sticks. So we'll see where that goes. But keep an eye on that. The other one is it's always important to pay attention to the folks that are trying to reduce costs. This is an industry where costs have been slow to be wrung out by technology. So as compared to other industries, so it's always good to be paying attention to pioneers that are trying to change that. And right now, one example that's probably worth paying attention to is Figure Technologies is building blockchain technology, and they've gotten the attention of a lot of people, and they've raised a lot of money, and they are trying to find a way to holistically solve this. And they've started, blockchain can operate wherever there's processes and information, but they've chosen the home equity space, and they're up to 80 to 100 million a month in HELOCs right now, and that's interesting to watch. They've made advances, so and their cost to do this is significantly lower. So just want to say, I want to pay attention to the pioneers that are doing that, and make sure that you're if that becomes available and becomes viable, that might fit into your scenario. And that's not a plug for Figures. That's just they're the company out there right now that's getting the most attention. The third thing is it's going to be interesting to see in the wholesale space the tug of war that's going on between the non-solicitation language and reconnecting with the borrower, because it's a zero-sum game. That's just an interesting battleground right now. And the fact that MSRs is a zero-sum game, that's a very intriguing boundary right now. So there's a lot of discussions going on, and I think it's important for originators to understand that those who buy the MSRs, they're buying the right to control that customer, and so there's interesting negotiations going on right now as to how to appropriately share that customer, but also keep the value of the MSRs appropriate. So it's just it's interesting to watch, and it's evolved a lot in the last 12 months. So just very interesting. And the wholesale space in general is just has really picked up as far as market share. So I remember, wasn't that long ago, 2007, when the wholesale space was disproportionately blamed for the mortgage meltdown, and now it's gone from typically that space controls 12-13% forever. It dropped below that right after the mortgage meltdown, and now it's way beyond that. So it's just a very interesting place. John, next question.
Fantastic. All right. So, in your opinion, how should mortgage origination companies manage their non-solicitation?
In a phrase, very carefully. The MSR owners are they have access to tremendous data, and they everything is a function of price, and you just want to make sure as an originator you really understand the rules, you really understand that they can track everything, and that you want to treat them as true partners. And if you want to have a place to continue to sell your loans and your MSRs, you want to make sure you manage that boundary with integrity, with people on the other side who have the money, are uniquely smart, and have the tools to manage it. So you just you want to know where that line is. You want to manage it accordingly, so that what they pay for it is what it's worth. And you don't want to back yourself into a corner where people are discounting your MSRs, or worst case, they don't want to buy them.
Wow, that's great.
The other thing I would say there, let me throw one more thing, and if you're dealing with wholesale companies, you want to make sure you understand how they're managing that boundary too. For example, if you're dealing with a wholesale company that is overstepping that boundary, what you don't want to do is have all your business at one wholesale company, and the next thing you know, they are adversely impacted because they've stepped over that boundary because they are selling the MSR themselves. So you got to know what your partners are doing. You got to make sure that your partners are managing that appropriately.
Wonderful. All right. So, it's a few people actually ask very specific questions about lenders. We're going to have your team get back to them, but I'm going to go to the next question here. Why do you think much of wholesale market has shifted from once a borrower is in our servicing platform, they are our customer, to reconnecting borrowers back to the broker originator?
Two reasons for that. One is technology is allowing them to export their expertise to the brokers. So technology is creating better capability to export that. But the bigger reason is the wholesale sector has become more aggressive in pushing that boundary. And so what I think we're going to see in the next, I'll say near term, in the next 12 months, I think you're going to see a defining of rules on the boundaries of just this topic. They're going to become clearer with the MSR holders. So the MSR holders are, I think, have as the wholesalers have very quickly become more aggressive, the MSR holders and aggregators are now responding with analytics to understand the impact of this, and they are fighting back is maybe not the right term, but they are getting better at defending themselves. And ultimately, they are the ones that buy the MSRs. So, everybody has to know what their leverage is. The originator's leverage is we find the customer, we sell it to you. The MSR's leverage is we have the money to buy your MSRs to fund your company. So the two have to. Right now, there is a kind of an unprecedented tug of war of where that line is, but I really think that that's going to be more clearly defined in the next 12 months. It's been evolving for about 18, and it's getting to kind of a fever pitch. And So that's going to be very interesting to watch really this year. And I think you'll start seeing that very soon.
Fantastic. So listen, we're gonna end this now because we just hit 1 hour, and we know we always try to keep this at an hour. I mean, there's some great questions. I feel JC, there's so much. I think so much more we can learn from you, and I really appreciate you taking the time to kind of to sharing your experience, your knowledge, and just insights, just to let us understand this unique opportunity that exists in the second mortgage and home equity space. John, always great to have you actually, to be able to work with you, to actually share your message with our audience. We really appreciate both of you guys making the time to connect with our audience today.
Thank you, Andrew.
Thank you, Andrew.
All right, and that wraps it up for another NMP webinar. Stay tuned to your inboxes for invitation to the next two in the home equity series that we're doing here. Thank you, everyone. Hope your January is going great. Hope you're going to have an amazing 2020. And with that, we end this webinar. Take care.